Imagine waking up, grabbing your morning coffee and seeing a news alert about, a potential military strike or a sudden shift in global interest rates.
Right.
But instead of just reading a standard headline, you see a livestock ticker attached to the news, flashing a literal real-time percentage chance of that actually happening.
Which is pretty wild to think about.
Yeah, totally. You aren't just reading the news anymore. You're watching traders price human history as it unfolds. And well, that is no longer a hypothetical scenario. It is April 1st, 2026, and prediction markets have just exploded into this massive $20 billion a month industry.
It really represents a fundamental rewiring of how we process reality. I mean,
Really?
for decades, we relied on pundits, polls, expert consensus, just to gauge the likelihood of future events.
Yeah, people just guessing, basically.
Exactly. But now we are looking at a highly liquid, financialized scoreboard where people are putting billions of their own dollars on the line to back up their foresight.
Right, which means we really need to understand the engine powering that scoreboard. So we've brought together a massive stack of sources for you today for this deep dive.
Mm-hmm.
We're pulling from internal financial ops reports, crypto exchange analyses, primers on the state of sports betting, and international market data, literally all from just the last few weeks.
It's a lot to unpack.
It is. And the mission for this deep dive is to figure out the actual mechanics of this booming ecosystem. We're going to explore the fierce regulatory turf war over who actually gets to control it. And most importantly, we need to find out whether these platforms act as incredible crystal balls for global events or if they're just high-tech digital casinos.
Well, to really grasp the gravity of this, you have to look at the sheer volume of capital moving through these systems right now.
Yeah, the numbers are crazy.
They are. In February 2026 alone, we saw $22.3 billion in what the industry calls notional volume across these platforms.
And just to clarify that term for everyone, notional volume just means the total face value of all the contracts being traded, right?
Yes, exactly. So this isn't a fringe internet hobby relegated to a few niche forums anymore. It has become a dominant financial sector. And right now, it operates essentially as a duopoly. Two heavyweights are dividing the vast majority of that market share, Kalshi and Polymarket.
And they operate under completely different philosophies. Like, if we look under the hood at Polymarket first, their entire architecture is built on crypto.
Right.
They operate on the Polygon blockchain, and all of the betting is done using a cryptocurrency called USDC. And the reason they use USDC is that it's a stable coin, meaning it's strictly pegged to the value of the US dollar.
So you don't have to worry about the wild price swings of Bitcoin.
Exactly, yeah. A digital dollar is always worth a dollar. And because of that borderless crypto-native architecture, anyone in the world with an internet connection can access it, which means Polymarket is capturing massive global geopolitical volume.
Oh, absolutely.
Our sources highlight a recent market predicting whether the U.S. and Israel would launch a military strike against Iran. That single question saw $252 million traded on it.
Yeah, and that level of liquidity, meaning the amount of ready cash flowing in and out of a single market, is unprecedented for a geopolitical event.
It's massive.
Polymarket thrives on international volatility. But Kalshi, on the other hand, is taking a starkly different, highly localized approach. They are a U.S.-regulated, fiat-based exchange.
Fiat-based just meaning they use traditional government money like your regular bank account, U.S. dollars, credit cards.
Right, no crypto involved at all. They operate strictly under the oversight of the Commodity Futures Trading Commission, the CFTC. Because they're operating within the strict bounds of U.S. federal regulation, instead of focusing purely on global conflicts, Kalshi is leaning heavily into mainstream American interests.
Especially sports, right, to drive user acquisition.
Yes, particularly sports.
And they are leaning in aggressively. I mean, just look at the $1 billion March Madness bracket challenge they launched. The mechanics behind this promotion are honestly brilliant.
They really are.
To enter, you have to verify your identity with a government ID and link a funding source. It's that process called KYC, or Know Your Customer. Once you jump through those hoops for the basketball tournament, the friction to start trading on other events is completely gone. Suddenly, Kalshi has millions of college basketball fans fully onboarded into their ecosystem.
It's a huge funnel.
Yeah, so think of how this works practically. It's like the stock market, but instead of buying a share of Apple hoping the company sells more iPhones, you're buying a share of the question, will the Fed hold interest rates? Or will Michigan's Yaxel Lendeborg win most outstanding player?
Right.
If you buy a yes share at 40 cents and the event happens, that share pays out $1. You make a 60-cent profit. So the underlying mechanics of an order book are the same as Wall Street. You're just trading on the probability of an outcome instead of the valuation of a company.
And that mechanism is exactly why traditional finance is suddenly so interested in this space. A recent study by the research firm Acuity found that 75% of U.S. proprietary trading firms are either already trading prediction contracts or are actively building the infrastructure to do so.
Wow, 75%. And proprietary trading firms, prop shops as they're usually called, those are the firms that trade their own massive war chests rather than client money.
Exactly. And what they see in prediction markets is the absolute holy grail of finance, which is uncorrelated returns.
Oh, that makes sense.
Right? Because if the traditional stock market crashes because of a terrible jobs report, a prop firm's stock portfolio bleeds.
Yeah.
But their prediction market contract on who wins a foreign election or who wins the Super Bowl is completely unaffected.
Wow.
If they can build algorithms to accurately predict inflation data moments before the rest of the market, I mean, the profit margins are staggering.
But when you have $22 billion on the line in a single month, people aren't just going to rely on public data. They will do whatever it takes to get an edge. And we're seeing a massive surge in behavior that looks an awful lot like blatant insider trading.
Yeah, we are hitting the absolute limit of what you'd call the information frontier.
Right.
Prediction markets are built on a concept called the wisdom of the crowd. The theory is that if you aggregate the knowledge, rumors, and research of thousands of independent people, the resulting average is remarkably accurate.
Usually, yeah.
But the messy reality of human behavior is breaking that theory. We are seeing instances where the crowd is completely overpowered by a single entity who already knows the outcome.
Like that bubble maps investigation.
Exactly.
Yeah, so our sources reference this specific investigation by a blockchain analytics firm called Bubble Maps. They tracked a cluster of heavily linked accounts on Polymarket that made a combined profit of $967,000 betting on those exact U.S. and Israeli military actions against Iran we discussed earlier. And here's the kicker. They placed these bets ahead of the news breaking to the public, and they did it with a staggering 90% win rate.
And in a market driven by intense geopolitical uncertainty, a 90% win rate over a sustained period is a massive statistical anomaly.
Yeah, you don't just guess that, right?
No, it strongly suggests access to classified, non-public information. And it's not an isolated event. Another trader recently turned a $32,000 position into over $400,000 by aggressively predicting the sudden downfall of Venezuelan President Nicolas Maduro.
Wow.
They placed those massive bets just hours before his capture by U.S. military forces. And that was a highly classified operation known to only a tiny handful of government and military officials.
Wait, hold on, though. If someone has a 90% win rate because they have classified intel, doesn't that completely shatter the whole wisdom of the crowd selling point?
Right.
I mean, that's not a crowd making an educated guess. That's just one guy who already has the script taking money from everyone else who is trying to guess fairly.
What's fascinating here is that tension is the core philosophical dilemma of the industry right now. But if we look at the actual mechanism of how these trades work, something bizarre happens.
What do you mean?
The very thing making the market unfair to the average user insider trading is the exact mechanism that makes the platform an incredibly accurate predictive tool for the rest of the world.
Oh, because of the automated market makers?
Precisely. These platforms use automated market makers and order books. If a market is sitting at a 20% chance of a military strike and a high-ranking official suddenly dumps $1 million on yes, the underlying algorithm mathematically forces the price of that contract up to 85 or 90 cents.
So the platform instantly adjusts the price to reflect that sudden influx of cash.
Yes. By moving the price, the insider is effectively broadcasting highly classified intelligence to the entire world in real time. Anyone watching the Polymarket ticker sees the spike and knows something major is about to happen.
That's incredible.
It transforms the platform from a simple forecasting site into a highly sensitive global intelligence oracle.
It's crowdsourced espionage, but I mean, the optics of this are a nightmare for the platforms. If you're running a multi-billion-dollar business, you can't have headlines accusing you of profiting off stolen military secrets.
No, you really can't.
So Kalshi is trying to get ahead of this by partnering with an integrity firm called IC360. They are deploying software that actively screens and blocks athletes, coaches, and politicians from trading on their own events. It's pre-trade blocking at the account level.
All right.
And Polymarket, meanwhile, rushed out heavily updated market integrity rules that explicitly forbid users from trading on stolen confidential information or, illegal tips.
Right.
They are trying to build these guardrails in a panic because they know the alternative. When foreign platforms are acting as real-time barometers for global warfare and billions of dollars are changing hands, regulators are going to intervene.
Definitely.
And that intervention has sparked an absolute civil war over who actually has the legal authority to govern this space.
Yeah, let's look at the underlying logic of this regulatory civil war, because the U.S. government cannot agree on what this industry actually is. The core debate comes down to definition.
Are these prediction contracts financial derivative swaps, or are they just games of chance-like gambling bets? And to be clear, we aren't taking a side on this debate here, but we need to understand the competing philosophies from the sources. If they're financial derivatives, they fall under the federal jurisdiction of the CFTC. If they're gambling bets, they fall under the jurisdiction of individual state gaming commissions.
Right. And the philosophy behind a financial derivative swap, historically, is risk management.
Okay.
Think of a farmer buying a contract that pays out if their crops fail, or an airline hedging against a sudden spike in jet fuel prices. The CFTC oversees these markets to ensure businesses can protect themselves from volatility.
Makes sense.
Kalshi fought an incredibly tough legal battle to get their CFTC license, successfully arguing that predicting an inflation rate or an election is a legitimate way for businesses and citizens to hedge financial risk.
But the states see it differently.
Entirely. The states look at a contract predicting the winner of a basketball game and see zero economic hedging. They see people putting money on an outcome they don't control, which fits the classic legal definition of gambling.
And the states are going on the offensive. Kalshi is currently facing over 20 federal lawsuits and enforcement actions initiated by state governments.
Yeah, it's a massive legal headache.
Massachusetts successfully won a preliminary injunction against them. Nevada issued a restraining order. Arizona went as far as filing 20 criminal misdemeanor counts against the platform, arguing that by offering these contracts, Kalshi is essentially operating an illegal, unlicensed sports book within state lines.
And while the states are attacking from one side, the federal legislature is stepping in from the other.
Oh, right, the new bills.
Yeah. In late March 2026, Congress introduced multiple bipartisan bills aimed at shutting down specific sectors of this market. One is the Prediction Markets Are Gambling Act, which is designed specifically to strip CFTC-registered platforms of the ability to offer contracts on sports and casino-style events. And days later, another sweeping piece of legislation called the Stop Corrupt Bets Act was introduced. This one targets the geopolitical side, attempting to ban any contracts on elections, government actions, and military conflicts.
I have to point out a major financial motive regarding the state's actions here, though. Let's look at New York. New York taxes mobile sports betting at a staggering 51%. In 2025 alone, that generated over $1 billion in pure tax revenue for the state budget. So we really have to ask, are the states genuinely worried about consumer protection and the integrity of these markets, or are they just looking at a massive, low-fee competitor encroaching on their incredibly lucrative tax monopoly?
Or that is the exact argument Kalshi's CEO is making in court right now.
I bet.
He contends that state enforcement actions have nothing to do with protecting consumers and everything to do with protecting monopolies.
Yeah.
When state budgets rely heavily on gaming taxes, a federally regulated platform offering better odds and significantly lower fees is viewed as an existential threat to the state's bottom line.
Yeah, and to see how chaotic this is, just contrast Kalshi and Polymarket with Predicted.
Oh, Predicted is a fascinating outlier.
Right. Predicted is a prediction market that has been around for years, and they are currently completely avoiding the crossfire. The reason they're safe is that they operate under a very specific, narrow exemption from the CFTC called a no-action letter, specifically Letter 2520. Under this letter, Predicted is structured as a not-for-profit educational project run by an academic institution. They recently had their individual betting limits raised to $3,500, but they strictly limit their markets to U.S. political and public affairs events.
Right, no sports.
Yeah, they don't touch sports. And because of that $3,500 cap, they don't reel in the billion-dollar volumes that threaten traditional financial or gaming institutions.
Predict it survives by proving they are an academic exercise, not a commercial powerhouse. But for the massive, unrestricted platforms, the regulatory battles are just the cost of doing business.
Yeah.
What is truly remarkable, however, is that despite the state lawsuits, despite the looming congressional bills, and despite the accusations of insider trading, everyday retail traders are still flooding into the market.
It's the Wild West, but the settlers are still pitching tents. And the reason for that is how these platforms are deliberately masking the complex mechanics of their technology to reach you, the casual user.
Exactly.
The mainstreaming of prediction markets is happening through massive partnerships. Robinhood, the app that originally gamified retail stock trading, has fully integrated Kalshi's markets into their main interface.
Which is huge.
This instantly brings prediction trading to 24 million casual users, and Robinhood is offering it with 0 user-facing fees.
That integration removes all the friction. You open your app to check your tech stocks or your index funds, and right next to it, on the exact same screen, you can take a position on the monthly inflation report.
Yeah.
Polymarket is making similar, highly strategic moves to broaden its appeal. They recently acquired a decentralized finance or DeFi startup called Brahma.
And this acquisition makes perfect sense when you look at the barrier to entry for crypto. It's honestly exactly what Apple did with the iPod click wheel.
Oh, that's a good comparison.
Yeah, before the iPod, MP3 players existed, but you had to dig through complex file directories and manual transfers. It was a huge technical headache.
Right.
And before this acquisition, making a bet on Polymarket meant setting up a digital wallet, buying a specific cryptocurrency, paying a network gas fee just to process the transaction, and bridging or moving your money across different blockchains.
It was exhausting for a normal user.
Exactly. Brahma is Polymarket's click wheel. It takes all that ugly back-end crypto plumbing and hides it behind a simple, familiar user interface. You just click deposit and the software handles the blockchain mechanics in the background.
And by removing those technical barriers, they are signaling to major institutional investors that this infrastructure is ready for mass adoption.
And the money is following.
Oh, the smart money is rushing in. A new venture fund called 5C Capital just raised $35 million, specifically to build the underlying plumbing of these market services like data indexing and automated market-making algorithms.
Wow.
Even more significantly, the Intercontinental Exchange, the traditional financial powerhouse that literally owns the New York Stock Exchange, recently expanded a $1.6 billion stake in Polymarket.
$1.6 billion. That is the traditional financial establishment placing a massive bet that prediction markets are permanent.
Sure.
But if you're listening to this and thinking about jumping in, there is one massive unresolved trench we need to navigate: taxes.
Oh, boy.
The tax situation for a retail user right now is a total nightmare.
Because the industry has moved faster than the regulators, the IRS has not issued a definitive ruling on how to classify the profits and losses from these specific contracts.
It's just a gray area.
Exactly. This leaves tax accountants deeply divided, with 3 competing schools of thought, and every single one of them carries risk.
Okay, let's break down what this actually means for a user trying to file their return. Option 1. You treat your trades like traditional stocks. This means you report them as capital gains and losses, where your losing bets can offset your winning bets up to a certain limit.
Right, which seems logical.
Right. Option 2. You treat it purely as gambling. But this is incredibly risky now because of a new law called the One Big Beautiful Act, and yes, that is the actual name of the legislation.
I still can't believe that's the name.
I know. Starting in 2026, this act limits gambling loss offsets to just 90%. So you can no longer write off 100% of your losses against your winnings.
And then there's option 3, which is highly desired by the trading community, but legally precarious.
What's that one?
This involves classifying the trades under IRS Code Section 1256. If a contract qualifies under Section 1256, it receives highly favorable tax treatment.
Okay.
60% of any gain is treated as a long-term capital gain, and 40% is treated as short-term, regardless of how long you held the contract.
Oh, that's huge.
It is. But tax professionals are explicitly warning users not to attempt this classification, unless the IRS formally approves it for these specific platforms, because an audit could trigger massive penalties.
And to make this headache even worse, neither Calci nor Polymarket provides users with standard end-of-year 1099 tax forms for their gains and losses.
You know,
If you're trading on Polymarket using crypto, you are entirely on your own. Your accountant has to track down your digital wallet addresses, match up the timestamps of every trade, and verify the transmission hashes, which are essentially the digital receipts on the public blockchain, just to figure out what you owe.
the burden of meticulous record keeping falls entirely on the user. The lack of tax clarity creates massive friction. But, when you look at the $20 billion in monthly volume, it is clear that the financial incentive for making correct predictions completely overrides that friction.
We have covered a massive amount of ground today. So if we distill all of this down, prediction markets have evolved from a niche academic thought experiment into a $20 billion global force. They are currently caught in a massive multi-front war. You have federal regulators at the CFTC trying to legitimize them, state tax collectors trying to shut them down to protect their gaming revenue, and members of Congress trying to write sweeping new laws to contain the geopolitical fallout.
Yet, despite all of that turbulence, these platforms continue to operate as highly efficient, real-time information engines.
Yeah, they really do.
They're providing unparalleled financially backed data on everything from the Federal Reserve's interest rate decisions to the outcomes of NCAA tournaments to highly classified global military conflicts.
And here's why you need to care about this. Even if you never place a single trade, and even if you never open a crypto wallet, the data these platforms generate is no longer just for traders looking to make a quick profit.
No, not anymore.
It is actively being integrated into how the world operates. Financial analysts, corporate risk managers, and global strategists are using this data to interpret reality. When the odds of a supply chain disruption spike on a prediction market, major shipping companies are watching. These platforms are becoming the lens through which institutions view the future.
They are replacing traditional opinion-based polling with raw, financially backed conviction. That represents a fundamental shift in the architecture of global information.
Which leaves us with one final lingering thought to mull over. We started this deep dive by talking about how the news cycle is now priced like a stock ticker. If these prediction markets continue to grow at this staggering rate and they become large enough and liquid enough to price in every major world event with near-perfect accuracy, well, do they merely reflect reality? Or do they eventually start to influence the actual actions of the politicians, the generals, and the CEOs who are obsessively watching those very odds?
When the scoreboard gets big enough, people start playing to the score. It is the ultimate feedback loop.
Definitely something to think about the next time you see a percentage chance attached to the morning news. Thanks for joining us on this deep dive.